A presidential signature just activated a mechanism that most investors don't understand yet. 6 months from now, the price you pay for silver and copper might not be set by supply and demand anymore. The clock is running, and the smart money isn't waiting for day 180 to make its move. The market rarely telegraphs structural shifts with this much clarity. Yet that's exactly what happened when the White House released findings from a Section 232 investigation into critical mineral dependence. The conclusions were direct. Current import structures for processed strategic materials create national security vulnerabilities that demand immediate policy intervention. And what followed wasn't a tariff announcement. It was something potentially more significant. A 180-day negotiation window designed to establish coordinated minimum pricing frameworks with allied nations. The target materials include lithium, cobalt, rare earth elements, and two metals that industrial buyers can't avoid, copper and silver. The language used in these proclamations matters. And when policy documents shift from discussing trade imbalances to addressing strategic supply chain vulnerabilities, the classification has changed. Trade disputes get resolved through commerce departments. National security threats activate different mechanisms entirely, mechanisms with far broader authority and faster implementation timelines. Here's what separates this approach from conventional tariff policy. Traditional tariffs add cost barriers to existing market prices. They make imports more expensive, but don't fundamentally alter how price discovery functions. Minimum import pricing operates differently. It establishes a floor below which foreign processed materials cannot legally enter domestic markets, regardless of what global spot prices indicate. The immediate market reaction revealed confusion rather than consensus. Silver experienced sharp downward pressure followed by aggressive buying. Copper showed similar volatility. Neither move reflected traditional supply-demand mechanics. Instead, the price action demonstrated what happens when over-leveraged positions meet unexpected policy announcements in markets already stretched by recent momentum. But focusing solely on the initial volatility misses the strategic timeline being constructed. 6 months provides enough duration to appear diplomatic, while creating sufficient urgency to force decisions. It's long enough for procurement teams to model scenarios, but short enough to prevent indefinite delays. More importantly, it's precisely the window that allows institutional capital to reposition without broadcasting their intentions. The first month typically brings headline confusion and contradictory analysis. Months 2 and 3 often feature optimistic progress reports and diplomatic statements designed to calm immediate concerns. The critical period arrives in months 4 and 5, when negotiation pressure intensifies and deadline realities force actual commitments. By month 6, public attention finally focuses on outcomes, usually after informed positioning has already occurred. This timeline matters because policy-driven market moves don't follow technical analysis patterns. They follow decision cycles. The entities with advanced information or superior analytical frameworks don't wait for official announcements. They model probabilities, assess likely outcomes, and position accordingly while liquidity still exists at reasonable prices. Understanding minimum pricing mechanisms requires examining how they function in practice. If enforcement establishes that processed silver products cannot enter below a specified threshold, the entire supply curve adjusts. The cheapest available supply disappears not through scarcity, but through regulatory exclusion. Buyers then compete for the next available tier, lifting the entire pricing structure even without demand growth. Implementation of such systems demands robust enforcement architecture. Reference pricing databases must be established. Import documentation requires verification. Classification systems need updating to prevent circumvention through product relabeling. Penalty structures for misreporting must carry sufficient weight to ensure compliance. What appears as a simple price floor actually represents a comprehensive regulatory framework. These frameworks create asymmetric outcomes. Entities operating within compliant, allied supply networks gain structural advantages. Their market access remains unimpaired while their competitive set narrows. Suppliers outside preferred networks face barriers ranging from documentation requirements to outright exclusion, depending on their relationship to the established framework. Section 232 authority deserves particular attention because its scope extends beyond conventional trade tools. Once an issue receives national security classification, political priority increases substantially. Implementation can include quotas, targeted restrictions on specific product forms, preferential treatment for allied suppliers, and rapid deployment when circumstances demand action. The negotiation period functions simultaneously as a diplomatic process and a credibility test. If administration officials announce intentions to address strategic dependencies and subsequently take no meaningful action, political consequences follow. Conversely, demonstrating follow-through on stated objectives reinforces policy credibility. Political incentives generally favor visible action over passive approaches, especially when attention remains focused on the issue. One scenario that markets consistently underestimate is the possibility that successful negotiations still produce higher prices. A completed agreement can include mutually accepted minimum pricing frameworks, commitments against predatory pricing practices, coordinated stockpiling arrangements, or voluntary supply limitations that function similarly to formal restrictions. The presence of an agreement doesn't guarantee that price pressures dissipate. The strategic question isn't whether negotiations succeed or fail. The strategic question is what price structure emerges regardless of the diplomatic outcome. Both scenarios, successful coordination and negotiation breakdown, can produce upward pricing pressure through different mechanisms. Understanding this reality prevents the mistake of treating diplomatic progress as inherently bearish for materials prices. 3 potential paths forward merit consideration. First, smooth coordination. Where allied nations accept pricing frameworks, supply continues with reduced volatility, and markets adjust to a higher baseline. Second, contentious negotiations, producing partial agreements filled with exceptions and conditions, creating sustained uncertainty. Third, breakdown leading to unilateral minimum pricing and restrictions, forcing rapid market adjustment. Each scenario carries distinct implications for different market participants. Physical holders face different risk profiles than futures traders. Mining operations encounter different opportunity sets than industrial consumers. Financial positioning appropriate for one outcome becomes problematic under alternative scenarios. This reality makes adaptability more valuable than conviction. The concept of government-enforced price floors triggers immediate skepticism among free market advocates. Yet the practical implementation of such mechanisms reveals complexities that transcend ideological positions. When states intervene in strategic materials pricing, the effects ripple through systems in ways that purely theoretical objections fail to anticipate. Consider the procurement perspective of large-scale industrial buyers. Manufacturing operations for electronics, defense systems, grid infrastructure, and automotive production require reliable materials access at predictable costs. Supply disruptions create cascading failures across production timelines. When policy signals indicate potential enforcement of minimum pricing 6 months forward, procurement teams face a binary decision: secure supply at current prices or gamble on future availability. This decision framework explains why price movements can accelerate before official implementation. The entity that delays purchasing while waiting for regulatory clarity competes for diminished available supply against those who moved earlier. Front-running government policy isn't speculation in this context. It's rational risk management by organizations that cannot afford production halts. The distinction between strategic materials and commodity materials becomes crucial here. Wheat, corn, and crude oil have deep, liquid global markets with multiple substitutes and diverse suppliers. Processed critical minerals operate differently. Refining capacity concentrates in specific geographic locations. Conversion to usable industrial forms requires specialized facilities with limited global distribution. Substitution possibilities narrow substantially for many applications. When minimum pricing applies to materials with concentrated processing, the leverage dynamics shift dramatically. Suppliers within compliant networks can extract higher margins because competitive alternatives have been structurally reduced. Buyers pay the premium or face the consequences of inadequate supply. This isn't market manipulation in the traditional sense. It's the intentional restructuring of market access through policy tools. The enforcement mechanisms for minimum import pricing require examining in detail. Simple price declarations prove meaningless without verification systems. Customs authorities need access to reliable reference pricing data. Import declarations must undergo scrutiny to confirm accuracy. Product classifications require standardization to prevent creative relabeling schemes. Appeals processes must exist, but cannot become loopholes that undermine the framework. Creating this enforcement infrastructure takes time, resources, and coordination across multiple agencies. It also creates opportunities for errors, inconsistencies, and unintended consequences during implementation phases. Markets dislike uncertainty more than they dislike specific outcomes. The transition period between announcement and full implementation often generates volatility exceeding the final steady-state impact. One aspect that policy discussions rarely address openly: minimum pricing frameworks can justify expanded government participation in markets. If private buyers face elevated costs due to policy-imposed floors, political pressure builds for subsidies, loan guarantees, or direct procurement programs. What begins as trade policy can evolve into industrial policy, then into direct market participation by state entities. Historical precedent offers guidance here. When governments decide specific industries merit strategic protection, the policy tools deployed tend to expand over time rather than contract. Initial measures described as temporary frequently become permanent. Limited interventions often broaden in scope as implementation reveals complications requiring additional corrective measures. The 180-day timeline may represent the beginning of a much longer policy evolution. The silver and copper markets illustrate why this matters. Silver serves dual functions as both industrial input and monetary hedge. Copper's conductivity makes it irreplaceable in electrification infrastructure. Both metals face supply constraints from multi-year project timelines. Both have limited recycling rates relative to demand growth. Both concentrate production in politically complex regions. When policy introduces minimum pricing into markets already experiencing structural tightness, the supply-demand balance shifts non-linearly. Small percentage changes in available supply can produce disproportionate price impacts. This sensitivity explains why even modest policy interventions in strategic materials can generate outsized market responses. The challenge for market participants becomes distinguishing signal from noise. Daily volatility during the negotiation period will produce contradictory headlines. Diplomatic sources will leak optimistic progress reports. Industry associations will warn of disaster. Political commentators will frame the issue through partisan lenses. Extracting actionable intelligence from this information chaos requires filtering mechanisms that most participants lack. What signals actually matter? Watch for changes in long-term offtake agreements between miners and industrial consumers. These contracts establish price and volume commitments extending years forward. When major manufacturers lock in supply at prices reflecting minimum floor assumptions, they're signaling their internal probability assessments. Following their capital allocation decisions provides more reliable guidance than following news commentary. Similarly, monitoring permit approvals and financing arrangements for processing capacity expansion reveals policy direction. If governments approve fast-tracked permits for domestic refining operations, they're confirming intentions to reshape supply networks. If development banks offer preferential financing terms for strategic mineral projects, they're signaling coordination on policy objectives. These actions speak louder than press releases. The mining sector response warrants attention because it reveals how policy changes flow through to operational decisions. Projects that appeared economically marginal under previous pricing assumptions become viable under minimum floor scenarios. Exploration budgets that faced skepticism from boards suddenly receive approval. Joint ventures that stalled over economics find renewed momentum. But not all miners benefit equally from these dynamics. Operations with proven reserves, existing permits, and near-term production timelines capture the most value. Early-stage exploration companies without clear paths to production may see temporary enthusiasm followed by disappointing execution. The difference between legitimate opportunity and promotional hype becomes critical during policy-driven market excitement. For individual participants considering exposure to these markets, the risk-reward calculation must account for multiple variables. Physical metal ownership provides direct exposure without operational risk, but offers limited leverage to price movements. Mining equity positions provide leverage, but introduce company-specific execution risk, management quality concerns, and political jurisdiction variables. Derivative positions amplify both potential gains and potential losses, while introducing counterparty and liquidity considerations. The appropriate strategy depends entirely on individual circumstances, risk tolerance, time horizon, and analytical capabilities. No universal answer exists. What remains constant across all approaches is the need for continuous reassessment as conditions evolve. The information environment during the 180-day countdown will shift repeatedly. Rigid positioning that ignores new data creates unnecessary risk. Trade policy rarely operates in isolation from broader geopolitical competition. The proclamation targeting critical mineral imports represents one move within a larger strategic framework. Understanding that context illuminates why this initiative carries implications extending beyond materials pricing. Multiple major economies currently pursue similar objectives: reduce dependence on concentrated supply chains, increased domestic industrial capacity, and greater control over materials essential to technological advancement. When several nations simultaneously attempt to secure access to limited resources, competition intensifies. That competition doesn't confine itself to market mechanisms alone. The negotiation phase explicitly targets allied nations for coordination. This approach acknowledges that unilateral action produces suboptimal outcomes. If minimum pricing applies only in one market while others maintain open access, supply simply redirects to those alternative destinations. Effective enforcement requires coalition building among major consuming nations, but coalition building introduces its own complexities. Different nations maintain different relationships with producing countries. They possess varying leverage based on trade balances, military alliances, and diplomatic history. They face distinct domestic political pressures from manufacturing sectors, consumer groups, and environmental constituencies. Achieving consensus across these diverse interests within 180 days represents an ambitious diplomatic undertaking. The possibility exists that negotiations succeed in creating a coordinated framework while simultaneously triggering retaliatory responses from nations excluded from the arrangement. If major processors face reduced market access to key consuming regions, they possess options for response. Export restrictions on unprocessed materials represent one tool. Preferential pricing for non-aligned buyers represents another. Strategic partnerships with competitor nations represent a third. These dynamics can cascade in unexpected directions. A policy designed to secure supply can instead prompt supply curtailment if producing nations perceive the framework as discriminatory. The attempt to stabilize prices through floors can paradoxically generate greater volatility if geopolitical tensions escalate. Policymakers operating with incomplete information about counterparty responses create room for miscalculation. The electronics manufacturing sector deserves specific attention because it consumes significant silver volumes while operating on thin margins. If minimum pricing substantially elevates input costs, manufacturers face uncomfortable choices. They can absorb costs through reduced profitability. They can pass costs to consumers through higher prices, potentially reducing demand. They can accelerate efforts to find substitute materials or more efficient use of existing materials. Each response creates different implications for long-term silver demand. Defense applications present different considerations because price sensitivity matters less than supply security. Military procurement budgets can accommodate higher materials costs if availability remains assured. This creates a two-tier market structure where strategic buyers may willingly pay premiums, while commercial buyers seek alternatives. Such bifurcation can produce pricing disconnects between different product forms and delivery timeframes. Infrastructure spending programs interact with these policy changes in mutually reinforcing ways. If governments simultaneously implement minimum pricing on strategic materials while launching major grid modernization or transportation electrification initiatives, demand pressures compound. The policy environment that raises floor prices also stimulates consumption through publicly funded projects. This combination can generate sustained upward price pressure beyond what either factor would produce independently. The monetary policy backdrop adds another layer of complexity. Central banks maintaining accommodative policies to support economic growth create liquidity conditions that amplify responses to supply constraints. When abundant capital meets restricted supply in strategic materials, price discovery can become disorderly. The intersection of loose monetary policy and tight commodity policy deserves more analytical attention than it typically receives. Environmental regulations represent an underappreciated factor in these dynamics. Permitting timelines for new mining and processing operations extend for years in many jurisdictions. If policy creates incentives for rapid capacity expansion, while regulatory frameworks prevent swift implementation, the gap between desired and actual supply growth widens. This timing mismatch can produce extended periods of elevated prices before new supply eventually arrives. The role of state-backed entities in materials markets will likely expand under minimum pricing frameworks. Government agencies may directly purchase materials for strategic stockpiles. Development banks may finance projects that commercial lenders avoid. National champions may receive preferential support over foreign competitors. This increased state participation changes market dynamics in ways that conventional supply-demand analysis struggles to capture. China's position deserves explicit consideration given its dominant role in refining and processing for multiple critical minerals. Any policy framework that limits Chinese processed materials access to Western markets will generate responses. Those responses could include export controls on unprocessed materials, preferential pricing for belt, and road partners, accelerated development of alternative processing capacity in aligned nations, or strategic acquisitions of upstream resources. The 180-day timeline coincides with other significant geopolitical developments. Election cycles, trade agreement renewals, and international summits create interconnections that can accelerate or delay policy implementation. Market participants must track these parallel timelines because they influence probability assessments for various outcomes. Secondary effects on related industries merit attention. If silver and copper prices rise substantially due to minimum pricing, industries dependent on these materials face margin pressure. Some can pass costs forward, others cannot. The competitive dynamics within electronics, automotive, construction, and renewable energy sectors will shift based on each participant's ability to adapt to elevated materials costs. Employment considerations enter policy discussions when domestic processing capacity becomes a strategic objective. Building new refineries and conversion facilities creates jobs, generates tax revenue, and develops technical expertise. Political constituencies supporting these outcomes can exert pressure for policy continuity, even if early results disappoint or costs exceed expectations. The risk of policy reversal always exists. If minimum pricing generates consumer backlash through higher product costs, or if allied coordination proves impossible to maintain, officials may retreat from implementation. Markets that price in one outcome then face rapid adjustment when policy shifts direction. This tail risk deserves hedging for participants with concentrated exposure. International legal challenges could emerge if affected parties view minimum pricing frameworks as violating trade agreements. Dispute resolution processes through the WTO or bilateral mechanisms can extend for years. The uncertainty created by pending legal challenges sometimes matters more than the eventual rulings because it clouds the operational environment. Financial markets will respond to these developments through multiple channels. Currency movements reflect relative policy tightness and trade balance shifts. Equity valuations adjust based on sector exposure to materials costs. Bond markets price in inflation expectations, influenced by commodity price trajectories. Derivative markets attempt to hedge these interconnected risks, sometimes creating feedback loops that amplify underlying moves. The information asymmetry between policy insiders and public market participants creates opportunities for front-running that disadvantage less informed actors. When negotiations occur behind closed doors, those with access to actual progress assessments versus public statements gain trading advantages. This reality makes timing entries and exits more challenging for individuals relying solely on public information. The transition from analysis to action requires frameworks that account for uncertainty while maintaining directional conviction. The 180-day countdown creates a defined timeline for reassessment, but market positioning decisions cannot wait for complete information. Successful navigation of policy-driven volatility demands probabilistic thinking rather than binary predictions. Physical metal ownership serves different purposes than financial market exposure. Holders of actual silver and copper remove counterparty risk from the equation. They don't face margin calls during volatility. They don't worry about contract rollovers or derivative settlement mechanisms. The trade-off involves storage costs, insurance requirements, and reduced liquidity compared to exchange-traded instruments. For those seeking physical exposure, the decision point centers on whether current premiums over spot prices reflect fair value for the embedded optionality. If minimum pricing frameworks arrive and produce the expected floor effects, physical holders benefit directly. If negotiations produce unexpectedly benign outcomes, they hold an asset with maintained industrial demand, but potentially reduced policy support. The downside appears limited relative to the upside if the policy thesis plays out. Mining equity exposure introduces operational leverage that amplifies both gains and losses. A 20% increase in metal prices can produce 40-60% moves in mining stocks if cost structures remain stable. But this leverage works in reverse during downturns. Additionally, company-specific risks around management execution, reserve quality, permitting timelines, and financing needs create variables independent of commodity prices. The current environment favors miners with specific characteristics. Operations already producing eliminate permitting risk and timeline uncertainty. Strong balance sheets reduce financing needs during potential market disruptions. Tier 1 jurisdictions minimize political risk. Manageable cost structures provide buffer if prices reverse. Operations exposed to both silver and copper capture dual upside if policy affects both metals similarly. Conversely, early-stage explorers and developers carry elevated risk. Promising projects can still fail to advance through permitting. Management teams can still misallocate capital. Financing can still prove dilutive if raised during market weakness. The spread between quality operators and promotional vehicles widens during policy-driven volatility as capital becomes more discriminating. The options market provides tools for asymmetric positioning, but introduces complexity. Long-dated call options on miners offer leverage with defined downside, but require correctly timing entry and exit. Selling puts generates income, but creates downside exposure. Covered calls cap upside while providing some downside buffer. Each strategy carries distinct risk-reward profiles requiring careful matching to individual circumstances. For industrial consumers of silver and copper, the strategic calculus differs entirely. Their concern centers on secure supply at manageable costs rather than speculative profit. The 180-day window creates urgency to lock in offtake agreements before potential floor implementation. Waiting risks, facing higher mandatory minimums or restricted access. Moving too early means potentially overpaying if negotiations produce favorable outcomes. Large manufacturers likely maintain scenario planning across the possible outcomes. They've modeled costs under various floor levels. They've assessed alternative sourcing options. They've evaluated materials substitution possibilities. Their procurement decisions during coming months will reveal internal probability assessments worth monitoring. The stockpiling question extends beyond individual actors to government agencies. If strategic material security drives policy, authorities may initiate or expand official reserves. Such programs can absorb significant quantities over sustained periods, creating persistent demand tailwinds independent of industrial consumption. Monitoring budget allocations and program announcements provides insight into official intentions. International participants face additional considerations around currency movements and jurisdictional exposure. A U.S. centric minimum pricing framework affects different parties based on their primary market exposure. Entities operating primarily outside impacted jurisdictions may experience less direct effect. Currency fluctuations can amplify or dampen nominal price changes depending on exposure patterns. The information flow during the countdown period will include substantial noise alongside genuine signals. Distinguishing between the two requires filtering mechanisms. What sources have demonstrated accuracy previously? Which parties have incentives to spin information favorably? What actions contradict public statements? These questions help separate signal from noise. Confirmation bias represents a constant threat during extended narratives. Bulls will emphasize supportive data while dismissing contradictory information. Bears will do the inverse. Maintaining intellectual honesty about contrary evidence preserves adaptability. The strongest analytical frameworks explicitly incorporate base rates, alternative scenarios, and disconfirming information. Portfolio construction matters as much as individual position selection. Concentrated bets on a single outcome create unnecessary risk. Diversification across physical metal, quality miners, and uncorrelated assets provides balance. Position sizing that allows for adding or reducing exposure maintains flexibility as conditions evolve. The psychological dimension shouldn't be underestimated. Watching positions fluctuate substantially during a 180-day window tests discipline. Markets will produce moves designed to shake out weak hands. Having predetermined rules for when to add, hold, or reduce positions helps counter emotional decision-making during volatility. One common mistake involves confusing timing the beginning of a trend with perfectly timing the optimal entry point. Waiting for the absolute bottom often means missing the move entirely. Accepting reasonable entry points rather than perfect entry points improves execution rates. Dollar cost averaging provides a systematic approach for those lacking strong conviction on timing. The ending of the 180-day period won't resolve all uncertainties. If negotiations produce agreements, implementation details and enforcement mechanisms will require months to clarify. If talks fail and restrictions arrive, market adjustment to the new framework will take time. The January deadline represents a milestone rather than a conclusion. Long-term implications extend beyond immediate price impacts. If this policy succeeds in reshaping critical mineral supply chains, it establishes precedent for similar approaches in other strategic sectors. The template of negotiated coordination, followed by potential unilateral action, could apply to semiconductors, pharmaceuticals, or rare earth magnets. This first-mover situation in strategic materials policy deserves attention from participants across multiple industries. The ultimate question isn't whether to hold positions through the entire 6 months, it's whether the underlying thesis remains intact as new information arrives. Thesis evolution as facts change demonstrates strength, not weakness. Rigid adherence to outdated assumptions while conditions shift represents the actual risk. For those seeking preserved purchasing power rather than speculative gains, the calculus tilts toward diversified real asset exposure. Precious metals historically serve this function during periods of currency debasement and fiscal excess. Policy interventions that signal government willingness to manipulate market prices can reinforce precious metals' role as alternatives to purely fiat systems. The 180-day countdown represents opportunity for prepared participants and risk for complacent ones. Which category applies depends entirely on current positioning, analytical frameworks, risk management discipline, and execution capability. The clock started when the proclamation arrived. How the next months unfold will separate those who understood the stakes from those who underestimated the significance.